Matt Robison, Beyond Politics, and today, what's actually happening in financial markets and what does it mean for all of us in our own lives? We've entered a period of incredible financial turmoil that's hitting us all in the pocketbook and in our retirement account, our college savings, and that's creating tremendous uncertainty for many of us in our work. Maybe the company you work for relies on building things and you can't get a hold of the parts you need at a reasonable price that won't kill off your customer base. Maybe you're part of a startup that doesn't have the cash to withstand a downturn. Maybe you're running your own business. Like me, I do my writing and podcasting, even my work for Newsweek through my own LLC. And like me, you might have things you need that are critical inputs to do what you do, and they're becoming harder and harder to afford. The issue of what's happening, how people who watch the markets are thinking about it, and what it means for our own personal financial lives is really top of mind for many of us right now. And that's why I wanted to bring in two old friends and consummate experts on markets, investing, and personal finance. Chris Hill is a multi-time guest on this show, the longtime host of Motley Fool Money, and now the host of an outstanding new podcast called Money Unplugged. Mike Morton is a personal financial advisor and was previously a technology entrepreneur himself. And he has a podcast called 5 Minute Finance. Side note, Mike asked an old friend to serve as the host of that podcast so that he could focus more on his own expertise, and that host is me. So if you're interested in either of those two outstanding shows, I'll put the link for both of them right in the show notes. And with that, here we go with me, Chris Hill, and Mike Morton. Maybe we can start to set the stage, and Chris, we can start with you. Just could you give us a snapshot of what the stock market and the broader investment picture looked like in 2024, kind of leading into this wild period?
2024 was a good year for the stock market, good year for people who are invested in the stock market. The S&P 500, which is generally seen as when we refer to the stock market, that's what we're referring to. The S&P 500 was up 23%. And that's an above average year, which is great. And it's really been a great 10 to 15 year run for the US stock market. There are a lot of reasons for that. Partly, you look at the big seven, the Mag 7, the seven biggest tech companies, did a fair amount of the heavy lifting last year. So I think when it's a good year for the biggest companies in America, it's generally a good year for the stock market.
Mike, you were saying recently on your show that there's this view, there's actually metrics of this that showing that toward the end of 2024, the stock market in general was overpriced. Was that because of the Mag 7, or was that kind of everything was overpriced?
Yeah, it's definitely because that was a big portion of it. You got these massive companies becoming more massive. And so a lot of those statistics, we hadn't seen those in decades. The stock market being really overpowered by the most massive companies and the capitalization, the market cap of those companies. But I would say overall, the whole market was very expensive. We've had not only, as Chris mentioned, in 2024, but 2023 as well was awesome. And the last decade has been awesome as well. And so things have just been running up, which is fantastic. But you can get a little complacent with, oh yeah, just things go up and to the right and my personal finances are looking fantastic. I'm ready to retire, but a couple of years we'll be there. And you got to take a step back and kind of look at the long-term history to see what might happen with your portfolios, especially as we've stepped into 2025 has given us that rude awakening.
When we talk about investing, we tend to focus on the stock side. The dirty little secret, of course, being that the bond markets are 3 times bigger than the stock market in the US, and they are a BFD. Could you just help me understand what about the bond side of this?
I'm not really an expert on the bond market at all. I'm not a bond investor. I know it's enormously powerful.
Wait, Chris, are you said you're not a bond investor? Does that mean you don't have any bonds? You must have bonds in your portfolio somewhere.
I think I do a little bit, but not in any significant way. I'm mainly in stocks and ETFs.
Cool.
Oh my
That's
gosh,
awesome.
you are like Tony KGB says in Rounders, you're very aggressive. You're not like balancing your portfolio at all, man. Wow, what a chutzpah on you. Mike, quick thoughts on the bond market?
Yeah, bonds are traditionally a great safer place. We were talking about personal portfolios, right? They don't tend to go up and down nearly as much as stocks, so they can be a nice buffer, especially if you're in and around retirement is when we really kind of look at some safer stuff in your portfolio because hey, I'm about to live on this, hopefully what's a pile of money. I'm about to live on this pile of money, and so we don't want it to drop by 30 or 40% the day after you retire. Yeah, that's how we typically look at bonds. And they sometimes don't perform like you expect. And we had that a couple of years ago. So you can't get too complacent on those guys either. You have to really know where you're invested and what it's there for.
I can't hear the phrase a pile of money without thinking about McBain on The Simpsons. And someone asks him, he's the Arnold Schwarzenegger knockoff, how do you sleep at night? And he says, on a pile of money with many beautiful ladies. Let's fast forward to today. How would you describe the current state of the markets in a sentence or two? Be pithy, but also be creative.
The first sentence is just one word, fraught. And for me, the second sentence,
I thought you were going to choose a different F word there, but sure.
No, fraught. The second sentence is, I think the current state of the market is much more international than it has been in the past decade. And if you'll allow me 30 seconds to expand on that, part of, as Mike referred to, the great run that the market has had over the last 10 years or so has been fueled by the fact that there are, outside the United States, institutional investors who collectively have tens of trillions of dollars that they are investing. And for the past decade, the United States has been a better than average place to put that money. And what we're seeing now, part of the shakeup that we're seeing now, is some of that international money is not flowing to the United States. And I think that is a small, long-term point of concern for US investors, that it doesn't get all the credit, not even the majority of the credit for the market's run over the last 10 years, but it does get some of the credit. And I think that's going to be a negative effect that we're going to see at a minimum throughout the rest of this year.
That's interesting. And just to quickly follow up on that. So if I understand right, you're saying that some of this overheating of the stock market that we saw over the last couple of years is because the US has been such an attractive place to invest, and all of the, let's say, fraughtness that we've been experiencing in recent months may have turned down the temperature on that trend when it comes to international institutional investors.
Exactly.
Yeah. And that money, it's funny, Chris, that money has to go somewhere too, right? People are sitting on money. And so the US has done really well compared to international markets over the last 20 years, right? US has been like the place. Why invest in international companies or international stock markets? Just stick in the US. It's fantastic. And that might be changing. And so I think individual investors need to be aware of that. Check your portfolios, US versus international. And I would definitely recommend continuing to have some international exposure. To your point, those countries might do well, international stock markets might do well, and that money has to be invested somewhere, and it might be more local to their countries.
Yeah, a particular type of investment vehicle that I've been hearing more about lately, Mike, and maybe you have too in your work, is the ex-US investment vehicles. These are mutual funds and ETFs that invest in every market in the world except for the United States.
Yep.
Oh my gosh.
Yeah, that's exactly right. And in fact, when I look at most portfolios of individual investors, they're very heavily weighted in US, which is natural. We have a home bias. If you live in the UK, you might be heavily invested in the UK. But globally, the US and the ex-US and the US have been basically 50-50 in terms of global investable assets. But the US has ticked up to 60 or 65%. If that comes back to 50-50, you can see how well those international markets are going to do.
By the way, Mike, we didn't give you a chance to give your one sentence or one word on markets. Would you like to make a creative entry?
Not very creative, but just volatile is what it is. And it has been the last few weeks. And I expect that to continue through 2025 and into the future, the next couple of years. A lot of unknowns unknown. This is the worth knowing feed, but I don't know what is going to happen. And I think it's more unknowable in the near future than it has been in the recent past.
Well, just springing off of that, is it possible that with all of this volatility and the nosedives, not to put too fine a point on it, but the nosedives that the market has undertaken recently, is it possible that investors are pricing in too much optimism or maybe too much pessimism right now? Is the market overcorrecting for some of the policy signals that they've been getting sent?
Well, in my opinion, it's definitely going to see a lot of overcorrecting in both directions. And we just don't know which way it's going to go based on whatever comes out next, whatever the next headline is. And what's also interesting, Matt, is I've been hearing a lot. People are very concerned. Oh my gosh, things are down, things are very volatile or fraught. And yet the market today is only down 10% from its most recent high, which is just that happens every year. So it's not even like from a personal investment standpoint, we're having a real mix up between our emotions, how we're feeling about things, and what the market's actually done this so far this year.
Yeah, the only thing I'll add there is I agree. I don't think the market is overreacting in any significant way. To Mike's point, it's absolutely worth remembering. Historically, the market is still doing well, which, if you want to take the pessimist point of view, that means there's still a long way to fall. And I think that what plays out over the next couple of months in particular, as we get to the halfway point of 2025, I think we're going to see. I think that's what's going to be worth watching is what happens to the container ships coming from China. Are they even more empty than the reports that we're getting right now? Do we start to see empty shelves when we go to our local stores? And then from a company standpoint, what sort of guidance do they give for the rest of the year and beyond?
Take me, just building, Chris, off that last point you were making, take me inside the mind of someone who does this professionally, who is a professional market analyst, watcher, interpreter. What metric or indicator do you watch most closely? And are you going to be watching most closely to see where things are headed?
There's not a single thing that I watch. I tend to watch a bunch of different metrics. The thing I've increasingly become interested in is how an individual company, if it's large enough, can give guidance about what they're doing in their business, and then what are the ripple effects from that one company. And I'll just give you a recent example. This week we got the latest earnings report from McDonald's. It's the biggest restaurant chain in the world. And one of the things that was said on the call, McDonald's executive said they're starting to see people pulling back on their breakfast orders. McDonald's is starting to see lower breakfast orders. I was interested to find out that in the same way that sales of pickup trucks tend to be a good indicator of the housing market and the home renovation market, turns out that breakfast sales at McDonald's are a good indicator of employment in the United States. So lower
Why is
breakfast
that?
sales, I think, because fewer people going out to work, fewer people going to their jobs, stopping for breakfast on the way. And it does kind of go hand in hand with the latest consumer confidence numbers that we saw as well. And consumer confidence is one of those soft yet important numbers that does not show up on the balance sheet. And that's what's really tricky about what's happening right now is a lot of this stuff that's happening with the economy in general and the stock market specifically has to do with things that don't show up on the balance sheet. And in this case, they're negative.
I thought you were going to say breakfast is down because more people are intermittent fasting.
There's probably some of that as well.
Could be.
I was going to say that I've actually had Joanne Shu, who is the head of that Michigan Consumer Confidence Survey, on this show before, walking us through it. And I think it's a very underappreciated metric in my neck of the woods in politics circles. It's astonishingly important.
Hey,
All right.
Matt, let me
Oh,
jump
yeah.
in real quick. And just on that note about the earnings, what's fascinating to me is how many companies are no longer want to publish forecasts, right? And so there's back to the unknowable future of, geez, they're not even wanting to give a forecast because they can't predict. There's no stability to what might be coming next, whether it's tariffs or taxes or whatever, or supply chain issues. And so they're like, shrugging their shoulders, be like, hey, you know what? We're not going to give you too many forecasts. And that's unusual, right?
It's a great point, Mike, because the last time this happened was 5 years ago in the early days of COVID. And there were a lot of companies giving their quarterly earnings report and saying, we're not giving any guidance. We're just not going to do it. We're not going to do it for the next quarter. We're not going to do it for the next year because there's so much uncertainty in the world with respect to COVID. Now, anyone listening to us right now, think back 5 years ago, the early days, the spring of 2020, and how uncertain the world was. That's what Wall Street is saying right now.
Wow.
This, in Wall Street's eyes, the economy in the United States right now and the global economic picture for many companies on Wall Street is as uncertain as it was 5 years ago.
All right. My editor's eye just perked up there. Is the pull quote here? We have as much uncertainty in the financial sector now as we had at the height of the COVID pandemic.
Yeah, I wouldn't argue against that.
Yeah, I wouldn't argue against it either. And we're hearing a lot of companies in their quarterly earnings reports say as much. How confident, if you're running a major corporation or even a mid-sized business or even a small business, how confident are you in your ability to plan for the next 6 to 12 months, whether it's the orders that you place for inventory, whether it's where you're going to have office space, or if you're McDonald's, where you're going to put your next restaurant, where you're going to build? How confident are you? Because those are multi-year projects. And if you're not confident in the next 6 to 12 months, you're not looking out any further than that. You're not making plans any further than that.
Yeah. And not only that, but just the cost of things in the next 6 to 12 weeks. You don't even know what they might cost your business. Your supplies running low from things you ordered a few months ago. You've got to re-up orders and you're not even sure how much that stuff is going to cost in the near future. So same as when COVID shut down and we don't know when foot traffic's coming back, right? Same thing. We don't know. It could be your cost could be double in 6 weeks from now from what they were 6 weeks ago.
From a personal standpoint, I have to say that I always think about this in the framework of my training, which is in economics. I know yours too, Mike. And I always think about income effects and substitution effects. Income being you feel like you have more income, you feel like you can spend more. Substitution being, well, if I need a product, I might substitute to something if I'm feeling wealthier that's a little more expensive, or I might substitute away. Maybe part of what you're seeing with Chris and your McDonald's breakfast effect is I'm going to choose a substitute. I'm going to just add breakfast items like a bar, a packet of bars to my grocery store because that's going to be cheaper overall. I'm going to make that substitution. I can tell you that personally, this amount of uncertainty is already affecting my own consumption patterns because we've already had a few interruptions in this recording. Part of it may be that my laptop is getting a little long in the tooth like me. And I went online and I literally asked ChatGPT yesterday, what are the prices of laptops been doing? Because I'm beginning to wonder if most of these components that are coming from China are getting priced up. And that is changing my personal consumption decisions. Laptop's incredibly important for my work, need a good functioning laptop, but I'm going to delay that investment decision, that spending decision right now for myself. And I imagine that kind of thing is getting aggregated across the whole economy. All right. So with that kind of general miasma of information kind of understood, some companies are not revealing everything that they think or that they don't know. You're getting all kinds of different indicators that you could pay attention to. Is there a kind of headline that you think people who are interested in this, either for their own personal investment or because they kind of care about where the economy is going, is there a kind of headline that you see and you think, we should ignore that? Is there a kind of headline that you see out there that you say, well, okay, this is the kind of thing that I wish the financial media was reporting on more?
I'll just say for myself, this is one of those times as an investor, I'm paying more close attention to what companies are saying. It's not to say that what comes out of the White House and what comes out of Congress isn't worth paying attention to. I think it is. But I think if you're an investor, if you're someone who is concerned about your money, you're thinking about making investment decisions of any kind, I would pay much more attention to what CEOs and their executive team are saying about their industry, their business, and the ripple effects thereof, and how they're planning to get through this. That's what I'm doing as an investor. And just the other thing I would just add to that is, this is one of those times where companies that have enormous piles of cash on the balance sheet are in much better shape. Growth companies that are unprofitable, tech businesses that have the hot new gadget or device, those can be exciting and profitable businesses. But this is one of those times where, as an investor, that's one of the first questions I'm asking. How much cash does this company have on their balance sheet? Can they get through the next year or two better off than some of their competitors?
Yeah. Yeah, you've seen the consumer staples doing well so far this year, right, Chris? Just to your point there. I totally agree. Listening to the commentary, especially from businesses, I think is really smart move right now, and trying to ignore a little bit of the crazy coming out of Washington or other circles, just in terms of your making personal decisions where to pay attention. I would also go back to a point we said earlier. The stock market's down 10% so far this year. It's basically kind of a blip. I would take the opportunity now to review your investments as well and say, look, to what Chris said earlier, we could go down way a lot more from here, guys. And so be ready for that. Make sure your portfolio, your personal portfolio, is ready for stocks to go down 10, 20, 30, 40%, from here.
Let me follow up on that with you, Mike, because you just did an episode on your podcast about, okay, what should the average investor do now? And what I mean by the average investor is the kind of person who probably isn't doing the kind of legwork that Chris described, of paying attention to what individual companies are saying, maybe not even invested in individual stocks, but is more invested in their 401k, their IRA, a taxable brokerage account, some kind of a broad index fund. Just, I want people to actually go over and listen to your podcast. So could you just give us like a little tease in a nutshell of what kinds of things the average investor should be doing with this much uncertainty and this much volatility right
Yeah. I'll keep it really simple for you. If you need money in the next 5 years from your portfolio, make sure you have that money available and it will not go down in value. All right. So if you're not retiring for 10 years, hey, keep your emergency fund, keep aggressively investing, no problem. If you're going to retire within 5 years and you need money from your portfolio, make sure you have that set aside now.
And if you're already retired, is there kind of like even more safety you can run to?
Yeah, typically we talk about having 5 to 10 years worth ready to go, ready to spend. That's in cash, straight cash, money markets, CDs, bank accounts, and safe bonds, very low volatile bonds that can get you some return as well. So I always recommend about 2 years of cash. If you're in retirement, 2 years of cash set aside, and the following 5 years in very safe bonds. So that gives you a 7-year cushion, war chest of 7 years, ready to spend in case, we don't know, in case the market goes down and it takes that long to recover.
Chris, I want to go one click level up from that. Let's say you're not full maniac Chris Hill level. Your avatar has not achieved like ultimate, I don't know what gamers call it, but anyway, you're not all the way to, I don't even invest in bonds. I look individually at every single stock. I read every 10K. Let's say you're kind of in between, right? And you might steer your investments just a little bit more than saying, yeah, broad market index fund. Are there sectors, asset classes that look especially attractive or risky to you right now?
There's a lot that's risky out there. So I don't know that we have time to go through all of those. I'll go back to something I said earlier, which is just companies that have a lot of cash on the balance sheet. I think that they're just better equipped to handle tough times. And by the way, tough times come typically every 4 to 5 years. We have a recession every 4 to 5 years or so. Now, the prospect of having a man-made recession like we might be in for at some point later this year, that's something we haven't seen in a very long time. But so I'm generally a fan of companies that have a lot of cash on the balance sheet. And just to pick one in particular, Berkshire Hathaway is a business that I've been a happy shareholder of for a few years. And Berkshire Hathaway is the conglomerate run by Warren Buffett, greatest investor of the last 100 years. And I think that business is set up for success after he is gone. He is in his 90s. At some point, probably this decade, although people have been predicting the demise of Warren Buffett for a long time. So don't hold me to this, but I don't know. He's in his mid 90s, Matt. I feel pretty safe in saying by the end of this decade, he's not going to be the CEO. Maybe he'll step down. Maybe it'll be something else. But I just think Berkshire Hathaway is such an incredibly complete business in the way that it is diverse and generates cash in so many different ways. It's really impressive. It's no surprise that so many books have been written about Buffett and Berkshire Hathaway. So that's one business in particular.
Yeah.
Do you want to just give me 30 seconds on Warren Buffett and the possibility that he might take Coca-Cola private?
That was something I read recently in the Wall Street Journal, because Buffett is very value oriented, and most of the acquisitions that the company has made over the last 50 years have been value-oriented acquisitions. That's how the company has grown. Buffett is not going to overpay for something. He just won't. But the company has built up such a massive reserve of cash, $300 billion in cash, that one of the more interesting proposals I saw was, what if they take Coca-Cola private? Coca-Cola is one of the biggest investments in the Berkshire Hathaway investment portfolio. It is the quintessential Buffett company. It is an American brand revered throughout the world. It has done so well as a business for shareholders and for Buffett. It would be a lot of money to take Coca-Cola private, but I would be surprised if they haven't had at least a couple of conversations at Berkshire headquarters about what that would look like.
I think this might run afoul of the whole theme of my Substack and this show, that there are some things that are worth knowing. The following thing that I'm about to say, here's something that's probably not worth knowing, but it's super fun to know. Did you know, people, I know the two of you know this, that there is an entire town, Quincy, Florida, that has the highest per capita wealth due to one shrewd financial investor, who a banker named Pat Monroe, who noticed that people loved the taste of Coca-Cola. And in the midst of the Great Depression, he not only invested in a lot of Coca-Cola shares himself, he urged his neighbors to do the same. And you know what? He was right. People love Coca-Cola. They do. They are addicted to Coke. You heard it here first. And all of those people became millionaires. It's absolutely wonderful.
Incredible.
All right. We're not suggesting necessarily that everyone should get into Coca-Cola, but notwithstanding what 90-something-year-old billionaires are going to do, I'm going to ask you to do something impossible, unknowable, and probably dangerous to your own career. Sound good?
Perfect.
Sounds wonderful.
I'd like to ask each of you first to take out your crystal ball and give us one prediction that you feel reasonably confident about for the next 12 months. Mike, you go first. I've known you the longest, so you go first.
Yeah, I'm going to piggyback on something Chris was talking about with the growth companies and being wary of those and loving the companies that have more cash on the books. I think value companies are going to come back in the next 12 months and the next 5 years. Growth companies have been crushing value for the last almost decade now, and I think that's going to flip. So that would be my prediction, is that value companies will be on more the upswing over the next 2025 and beyond.
All right, slide off the hot seat. Chris, you're on.
I couldn't help but notice that when you asked your question, Matt, you didn't actually include the word financial in your descriptor. I'm going to predict that the Boston Red Sox will, in fact, make the playoffs this year.
Oh my gosh. What a cop-out. What a dodge. I love it. 5 Ds of dodgeball worthy. All right. I'm not going to let you off because I hinted that there would be a two-parter. And this is the second opportunity to immolate your career. Chris, you go first. Give me your hottest take on the financial sector or personal financial planning? Your very hottest take.
My hottest take. My hottest take is that we're going to see in the next 12 months, so let's say by the middle of next year. Let me just check one thing real quick because I want to make sure I'm okay. The 5 biggest companies in the stock market are all US-based companies. I think by this time next year, that's no longer going to be the case. I think we're going to have at least one international company in the top 5, and it's possible that we're going to have at least 2 international companies in the top 10 next year, much in the same way that one of the greatest exports America has given the world is the sport of basketball, but some of the best basketball players in the world are not United States citizens. They are international players.
Yes, like the MVP for the last 5 years running. Like
exactly.
That. Yeah.
In that same sense, I think the ripple effect that I referred to earlier in our conversation about part of what has fueled the rise of the US stock market over the last 10 to 15 years has been investment from outside the United States, from institutional investors in other countries. I think that ripple effect continues, regardless of what happens with tariffs or anything else. I think this is a little bit of a turning point. It's not to say that investment in the US goes to zero, but it does start to get scaled back. And I think one of the ripple effects of that will be the rise of some of the biggest companies outside the US.
All right, Mike, give me your hottest take.
Yeah. I had a couple of thoughts, but I'm gonna double down on what Chris said and what we talked about earlier, that I think international investing is the place to be. I think it's been a dog for many years and people have given up on it because the US since the start of 2000 has just been crushing international investing. And I think it's going to go the other way. I think you don't want to sleep on being in the ex-US, as we mentioned earlier. Everywhere else except the US, I think will be a great place to be investing in the near future.
So what you're saying is what we've accomplished is make Latvia great again. I love it. I want to enter my own nomination for hottest take, which is something that I figured out helping you out on your podcast, Mike, which is, and this is somewhat financially related, which is people let go of optimizing. Optimizing is for suckers. What I mean is optimizing is fruitless. The quest to try to get something perfect, to try and get it just right, is going to take up so much of your time, energy, emotional capital. It's not worth it. Good enough answers are good enough. And that is partly my way of just teeing up our final thing for both of you. Just give me 30 seconds on what you're up to on your show and what you're doing. You're both doing innovative things in media tied to finance. And Mike, I'll let you go first here because I just served it up on a platter for you.
Yeah, just working with individual investors and families to make sure you have the correct financial plan. The podcast I do with you, Matt, is fantastic. I get a lot of great feedback on keeping things simple, right? Because we're overwhelmed with possibilities and with trying to optimize and get the very last little bit out of everything. And life is way too busy these days. So I think you're right. The good enough job is exactly where you want to be. Set yourself up for success, but don't make it stressful.
And Chris, you are doing something really different and interesting. It's not that different. You're still in finance, but like really different from your longtime perch on Motley Fool Money. Tell us about Money Unplugged.
For all of my interest in individual companies and stocks, and that does continue, something I've gotten more interested in over the last few years is the emotional side of money, because every one of us has a relationship with money. It comes with anxiety and excitement, and I wanted to have conversations with people about what their own relationship with money is, starting with when they were a kid, what they remember about it growing up, their first job as a kid, how money changes as you get older and maybe get married, start a family, that sort of thing. So that's really what Money Unplugged is. It's a weekly conversation that I have with people. Episodes are around 30 minutes long, and there's sort of a fun speed round at the end of every conversation where I get to ask people things like, what's the last thing you splurged on? And let me tell you, some of the answers I've gotten on the splurge question are outstanding.
You know what I'm looking forward to splurging on? New laptop. Hope the tariffs come down soon, people. All right. On that note, and speaking of keeping things to about 30 minutes, we are about done. Mike, Chris, thanks so much.
Thanks, Matt.
Thanks, Matt.